What you do not know can hurt you financially. What's the perfect way to set up your life assurance policy? Your estate includes everything from your home to your vehicles and savings. The issue of whether you pay inheritance tax or not depends on the value of your estate when you die. If your estate is worth more than a certain amount, then you will have to pay tax on the value of the estate above that threshold. Importantly, any life insurance policy that is not written in trust is included in the calculation of your estate. As a result, a certain percentage of that payout may be taxed, rather than going to provide for your loved ones after you die. Joint life insurance policies usually cannot be written in to trust, and the survivor receives the benefits straight away, therefore increasing the value of the estate. Plans proposed this way can lead to additional tax being paid. This isn't the case if your policies are proposed as single life in trust, as a policy in trust is viewed as being outside of your estate. Use life insurance to clear mortgages. You should never set up a life assurance policy in multiples of more than £325,000. A poorly executed life assurance policy will most likely cause you to break through your inheritance tax allowance on the second death and erode or lose the additional residence nil rate band allowance. In the instance where a property investor requires £1 million life insurance to cover their mortgage, 4 times £250,000 life policies would be set up and assigned to 4 different trusts dated on different days, utilizing the Rysaffe Principles, therefore, keeping the value of each below the nil rate band of £325,000. On death, the trustees could borrow the money from the trusts and repay the mortgages, freeing up all the rental income. Although you have paid your mortgages off, your estate value wouldn't increase as the money would be owed to a trust, which, upon the discretion of the trustees, next generation, could be paid back and could be used to reduce the estate value and therefore reducing the inheritance tax on your estate. What is the Rysaffe Principle? The Rysaffe Principle dates back to 2003 in the case of Rysaffe Trustee versus Inland Revenue Commissioners. In this, the court ruled that where a series of trusts are created by the same settlor, they will not be regarded as related settlements for inheritance tax purposes, provided they are created on different days. Where this is the case, each trust benefits from its own nil rate band. This is significant because a trust is assessed every 10 years, and if its value exceeds the nil rate band, currently £325,000, the excess will be subject to a periodic charge, a maximum rate of 6%. By using the Rysaffe Principle to create a series of smaller trusts and thereby benefiting from multiple nil rate bands, it reduces the risk of periodic charges as well as exit charges when capital later leaves the trust. The Treasury has explored ways to challenge the principle. In 2013, it considered introducing a single settlement nil-rate band, which would be divided across all of a settlor's trusts. Instead, it opted for an anti-avoidances same-day added property rule, which came into effect in 2014. While this means the Rysaffe Principle is no longer effective for multiple pilot trusts set up with a nominal value, it remains a valid planning tool for life assurance protection plans. Writing a policy in trust can mean faster payout to your loved ones. If your policy is written in trust, the payout is managed separately to the distribution of your estate. As your loved ones don't need to wait for probate to be granted, the payout will go directly to your loved ones and more swiftly to boot. Taking control. A benefit of writing your life insurance policy in trust is that you enjoy a little more control over who gets the money from your payout when, and no inheritance tax to pay, or loss of valuable allowances. The trustees can also oversee the money until your children are old enough to manage it themselves. Secure your legacy. Your future generations will thank you. Thank you for watching this presentation from Finance Legacy. If you found this information useful and want to find out more, contact David Nicklin using the details on the bottom left.